Many parents have asked if a Parent Plus loan is the right type of loan for them and their child as they plan to go to college. The answer can be a little bit nuanced. There are some benefits that can be utilized within Parent Plus loan, but there are also the downsides that you should be aware of. In this video, we're going to cover the many benefits that you can use from a tax planning perspective by either taking out a Parent Plus loan or a qualified student loan in the parent's name only. What's going on, everybody? I'm Daniel Cieniewicz, the college dude. So today we're going to talk about parent loans that are qualified student loans. The most popular type is through the federal government, direct to the Department of Education, direct Parent Plus loans. These types of loans, as we've done in previous videos, can be a little bit higher interest than what you're seeing from the direct loans that are in the student's name only. They also have an origination fee, but they're in the parent's name only and the student has no bearing with them. The other thing to keep in mind is that these are available to undergrad dependent students. So if a student is going to grad school, they are then going to be responsible through their own name for certain types of grad plus loans that are available to them. The other type of parent loans that can be out there are some private student loans that can be offered to parents. Many of these loans are going to be offered through state agencies. But what you want to be aware of is if you do take out this loan, you want to make sure that you're coordinated with the financial aid office, that they're able to accept those types of loans. Not all financial aid offices are going to accept a loan that is in a parent's name and does not have the student listed to it. Make sure that you check with the financial aid office to avoid this type of mistake. That being said, if you do take out a parent loan in your name, whether it be a plus loan or through a private entity, and it is a qualified student loan, there are some tax planning items that you could be eligible for. The first one is for parents, you could be eligible for the student loan interest deduction. So many students are aware of this deduction that's available to them. And we, again, did a prior video on this to go through what the student loan interest deduction consists of. However, you're able to deduct up to $2,500 of interest that you pay in a given tax year and deduct that against your marginal income tax bracket. One of the big benefits of the student loan interest deduction is it's what's considered an above the line deduction. So what that means is that you can still use a standard deduction, which many parents do, and still be able to deduct this interest. It's not something that's required. You don't have to be itemizing your deductions in order to utilize this benefit. You can still use a standard deduction and claim the student loan interest deduction. Therefore, plus loans are eligible if it's in your name. Since you are legally required to repay that as the parent, you can then utilize the student loan interest deduction so long as you fit within the income limits that are available to you. If you have more than $2,500 of interest per year that you're spending on, an additional type of benefit or tax strategy can also be utilized. This can also be utilized by taxpayers who maybe have phased out of the student loan interest deduction income range. If you've phased out, something that you can then do is put money into a 529 plan in your name. That 529 plan in your name, you can be both the custodian and the beneficiary. A recent law that was passed allows up to $10,000 of $529 to be able to pay off an eligible student loan. Therefore, you want to make sure that you check the requirements, because what you could be doing is, depending on your state, you can get a state tax deduction by putting money into a 529 plan. By then taking that 529 plan and paying off that student loan, what then ends up happening is that any interest that has grown in there can be utilized tax-free. You can always transfer any leftover 529 funds to a student, to your child or a beneficiary who's related to you. Therefore, it's something to consider. If you need to pay off the loan anyway, you can use the 529 as a conduit to potentially save on state taxes. If you and your spouse have ended up utilizing the Parent Plus loans and they're in each of your names, you can use the 529 plan in both of your names, as this is a $10,000 per beneficiary lifetime exclusion. What you need to be aware of is if you do utilize this $10,000, That's it. You're not able to use this if you decide to go back to school or want to pay off another student loan at any given point. The IRS allows for up to $10,000 lifetime per beneficiary to utilize this benefit. Two important disclaimers here. Number one, this strategy needs to make sense because you may be double dipping if you utilize both the 529 plan deduction, which pays off the student loan, and the student loan interest deduction in the same year. It's best if you make sure that you are over the $2,500 interest amount, then you can utilize the 529 plan deduction, the student loan payoff beyond that point. If you are in a situation where, again, you're phased out, you also want to make sure that the state allows this to take place. Not all states have deducted the federal rule in which you're able to take a $10,000 lifetime payoff from a 529 plan to then pay off a loan. Some states do not follow that federal regulation, so you could be subject to state tax penalties if you decide to go down that route. You want to make sure that you're aware of your state rules in addition to the federal rules if you're going to be employing this strategy. We've also previously talked about public service loan forgiveness when it comes to Parent Plus loans. Just to reiterate, there are two great benefits that you can look into when it comes to public service loan forgiveness and Parent Plus loans. The first one is the double consolidation strategy. Now, again, if you are a junior or if you have a junior or senior, and that's going to be it for you for Parent Plus loans, there are going to be no more after that point, you might be able to fit this in time. This loophole, I should say, is going to be going away in July of 2025. At that point in time, once it's no longer available, the double consolidation strategy, the only option that's available is the income contingent repayment plan to go into public service loan forgiveness. It's not quite as favorable when it comes to being able to pay off or being able to get through on a monthly payment and also then qualifying for public service loan forgiveness. So you want to make sure that you're aware of if you decide to go down that route, how much your monthly payment will be, and if you can qualify for public service loan forgiveness. We did another video on that, so feel free to check that out for more information if you think you'll be a candidate for it. As always, these videos are educational in nature only, and they are not meant to be taken as specific advice. If you have any questions or you want to apply any of these to your specific situation, you must first speak with your financial planner, CPA or tax accountant, and tax attorney before implementing any of these strategies. As always, I hope you found this information to be insightful. Please feel free to like this video, to share this page, and to subscribe to my channel for more future content when it comes to paying and saving for college in the most efficient way. Until next time.